All right, Andrew John here. I need you fully focused for the next few minutes. What I'm about to walk you through isn't a guess, it isn't a theory, and it's not another headline that will disappear from the news cycle by next week. This is about a structural fracture forming right now inside a segment of the financial system that most people don't even realize exists. I'm talking about the shadow banking system. Over the past 72 hours, liquidity stress indicators have surfaced at levels we haven't seen since March 2020, and before that, September 2008. The overnight repurchase agreement market, the repo market, has experienced a rate spike that signals major financial institutions are scrambling for short-term funding. At the same time, money market funds have seen outflows at magnitudes not witnessed in more than 2 years. And the commercial paper market, the core engine of short-term corporate financing, is beginning to show signs of freezing. This is not a visible market crash. It's not chaos in the streets. It's something far more subtle and far more dangerous. It's the silent activation of systemic stress in real time. And Wall Street is working overtime to keep it away from the headlines long enough to unwind positions and shift risk. By the end of this breakdown, you'll understand what shadow banks actually are, why their failure could make 2008 look like a preview, and most importantly, the 3 asymmetric strategies that deserve attention right now, while there's still a window. This isn't fear-based commentary. It's about recognizing patterns, understanding historical precedent, and acting before the crowd realizes what's unfolding. So eliminate the distractions, grab something to take notes with, and let's dissect the most important financial development that almost nobody is discussing. Before we dive into the current stress, we need a framework. Most people think the financial system consists of banks, stock exchanges, and maybe hedge funds. But the reality is that more than half of all lending and credit creation in developed economies occurs outside traditional banks. This parallel system is known as shadow banking. It includes money market funds, hedge funds, private equity firms, insurance companies, pension funds, structured investment vehicles, and other entities that conduct bank-like activities without being regulated like banks. And that distinction matters. Traditional banks operate under strict regulation. They maintain capital buffers. They undergo stress testing. They have access to the Federal Reserve's discount window in emergencies. They carry deposit insurance. Shadow banks do not. They often employ extreme leverage, 20 to 1 or more. They rely heavily on short-term funding markets that can seize overnight. And when trouble emerges, there is no guaranteed safety net. The asymmetry is stark. During stable periods, shadow institutions enjoy amplified upside through leverage. But when stress hits, contagion spreads rapidly because these entities are deeply interconnected with banks, pension systems, corporate treasuries, and sovereign wealth funds. According to the Financial Stability Board, the global shadow banking system now controls more than $200 trillion in assets, more than twice global GDP. Most of it is financed with short-term debt that must constantly be rolled over. If trust falters, if liquidity evaporates, if counterparties refuse to extend overnight funding, the structure can unravel in days. The core thesis here is straightforward. Early-stage liquidity strain is emerging in the shadow banking ecosystem. It's being driven by elevated real interest rates, an enormous global debt burden that cannot comfortably be serviced at current borrowing costs, and a regulatory system built to address the previous crisis, not the next one. This stress typically unfolds in 3 phases. Phase 1. Quiet deleveraging. Institutions reduce exposure discreetly, attempting not to alarm markets. Phase 2. Forced liquidation. Asset sales accelerate, price discovery becomes distorted, and volatility spikes. Phase 3. Systemic contagion. Traditional banks become entangled, and the crisis spills outward. We are currently in Phase 1. The signals are present if you know where to look, but the broader narrative hasn't caught up. That disconnect creates opportunity for those who understand the mechanics and position accordingly. To understand today's setup, we need to revisit 2 historical episodes, because what's happening now isn't unprecedented. It's a modern replay of earlier financial scripts. The first parallel is 1929 through 1933, the Great Depression. Most people associate that era with the stock market crash, but the deeper devastation stemmed from the collapse of the era's shadow banking system. In the 1920s, Much of the lending wasn't done by commercial banks. It was driven by investment trusts, holding companies, and broker-dealers using massive leverage. They borrowed short-term funds to finance long-term positions in equities, property, and corporate bonds. When markets crashed in October 1929, asset values collapsed, but liabilities remained. Short-term lenders refused to renew funding. Margin calls cascaded. Within months, hundreds of leveraged entities disappeared. The damage then spread to traditional banks that had exposure to these institutions. Between 1930 and 1933, over 9,000 U.S. banks failed. The money supply contracted by roughly 30%. The lesson? The destruction was credit-driven, not merely a stock decline. Those who protected wealth moved out of fragile financial assets early and into tangible stores of value, gold, farmland, real assets, before the worst of the collapse. When gold was revalued from $20.67 to $35 per ounce in 1934, holders gained significant purchasing power while others were devastated. The second parallel is 2007-2008, the modern shadow banking crisis. Leading up to 2008, an enormous off-balance sheet financial architecture developed. Mortgage-backed securities, collateralized debt obligations, structured investment vehicles. These entities borrowed in the repo and commercial paper markets to fund illiquid, long-term mortgage assets. Leverage ratios often exceeded 30-1. When housing prices reversed, cracks appeared. Hedge funds collapsed. Institutions faced funding pressure. By September 2008, after the failure of Lehman Brothers, the repo market froze. Money market funds broke the buck. Commercial paper markets seized. This was not a conventional banking crisis. It was a shadow banking implosion that dragged the regulated system down with it. The Federal Reserve had to deploy extraordinary facilities to prevent total collapse. And the earliest warning signs? Funding market stress, rising repo rates, widening spreads, slowing commercial paper issuance. Sound familiar? Now bring this into the present. The overnight repo market, the plumbing of global finance, is showing strain. Normally, repo rates track closely to the Federal Reserve's policy rate. Recently, spreads have widened, suggesting certain institutions are paying a premium for cash. We saw a similar dynamic in September 2019. We saw it again in March 2020. Money market funds are also experiencing significant outflows. Investors don't pull large sums from safe funds without reason. Either they require liquidity urgently or they're losing confidence in counterparties. Commercial paper issuance has contracted sharply. Spreads over Treasury bills are widening. That's a textbook signal of declining confidence. When lenders hesitate to extend even 30-day credit, that's not noise. That's structural stress. Why now? Because leverage built during a decade of near-zero interest rates is colliding with a higher rate reality. After 2008, central banks suppressed yields through quantitative easing. Borrowing was cheap. Leverage became normalized. Then beginning in 2022, rates rose aggressively. Servicing short-term debt suddenly became far more expensive. Institutions built on thin spreads are now squeezed. They either refinance at higher costs or liquidate assets. This is deleveraging. Compounding the risk is collateral rehypothecation. In repo markets, collateral can be reused multiple times. One treasury bond might underpin several borrowing chains. That works until it doesn't. If a major participant fails, collateral gets trapped. Counterparties are left exposed. This dynamic accelerated contagion in 2008. Derivative exposure adds another layer. The global notional derivatives market exceeds $600 trillion. These contracts assume counterparties remain solvent. In systemic stress, that assumption weakens quickly. Risk concentration is also greater today. A handful of large institutions dominate U.S. banking assets. Their interconnectedness means that stress in shadow banking doesn't stay isolated, which leads to the strategic question, what positioning makes sense? First, short-duration U.S. Treasury bills. They are the ultimate liquidity instrument in a funding crisis. Downside is limited. Upside comes from capital preservation and optionality. Second, physical gold and silver, not paper proxies, physical holdings. In crises, counterparty-free assets regain prominence. During past systemic stress, gold rallied sharply as confidence in financial intermediaries eroded. Third, volatility hedging. When systemic stress escalates, implied volatility expands dramatically. Tail risk hedges can provide asymmetric payoff if conditions deteriorate. Beyond positioning, practical steps matter. Reduce exposure to leveraged credit vehicles vulnerable to liquidity freezes. Examine where cash is held. Government-only money market funds or direct treasury holdings minimize counterparty exposure. Limit personal leverage. Margin amplifies forced liquidation risk. Build liquidity. Optionality belongs to those not forced to sell. And if you understand derivatives, consider structured volatility protection while it remains relatively inexpensive. The larger question remains, is this temporary friction that central banks smooth over, or the opening chapter of a broader systemic event? That's the discussion worth having. What matters most is recognizing that funding stress typically precedes headline crises. By the time mainstream outlets acknowledge systemic risk, repositioning becomes far more expensive. This isn't about panic, it's about preparedness. The shadow banking system is showing strain. Funding markets are flashing early signals. Liquidity, the invisible glue holding modern finance together, is under pressure. History shows that those who act early preserve capital and gain opportunity. Those who wait for confirmation often absorb the damage. Stay focused. Stay liquid. Stay positioned ahead of the curve.